Our advice would be to the Reserve Bank is don't act early, keep your powder dry and take some action down the track when you maybe need to provide a more significant stimulus to the economies.
Dr. Robert Mellor, welcome to Dukascopy TV. It's a pleasure to receive you today.
Thank you very much for having me.
No problem at all. Now, we're going to be taking a look at your latest report regarding residential property. Now, let's take a look firstly at what were some of the key findings with regards to those pricing trends and forecasts moving forwards.
Look, I suppose the big thing is that's changed this year and probably compared to a year or 2 years ago is that we've seen a lot of construction going on in the residential sector. And we've moved from what has been probably for the last quite a number of years a significant undersupply of residential property to the fact now that really outside of Sydney, all markets over the next 12 months will either be in oversupply or increasing oversupply because they've already moved into oversupply over the last 6 to 12 months. So that's probably the biggest change in the market, and of course with that oversupply developing based on our historical experience, that usually means you're in for slower growth or even the risk of price declines.
Now, I also wanted to understand the role investor demand plays here. I mean, as we know, Australia and Sydney and all across all of the capital cities, there is a great demand from both domestic investors and also overseas investors.
Yes, look, depending on which market you're looking at, certainly in off-the-plan sales, those markets are heavily dependent upon investors. In some markets, 15, 20, even 25% of sales are being achieved, say in a Melbourne apartments or in a Sydney apartments, are being achieved to offshore investors. And probably local investors could account for 50 or 60% of the market. In many cases, you would only find sort of owner-occupiers accounting for 20% or 30% of the market. So investors have been a key driver of the market. It's been the main reason why price growth has continued to be so strong, particularly in Sydney and Melbourne over the last 12 months. But we think that's probably coming towards an end because as oversupply develops, you start to get rising vacancy rates, you get rents either declining or no growth in rents, and then ultimately you get prices having peaked and potentially having little potential for further price growth. That sort of scenario usually discourages investors to go into the market, and of course those investors who've been in the market, some of them decide to take their capital gain on established property and sell. So we think that we're in for a period where there's a substantial reduction in investor demand. The latest figures would show at least a 10 or 15% decline over the last probably 9 months in terms of lending to investors. And I suspect while the offshore investors haven't yet declined by that sort of magnitude, they will because there's been a rise in the amount of tax that effectively state governments are putting on overseas investors. And so therefore some of those overseas investors will say, well, I don't want to pay that extra 4 or 5% in tax, stamp duty. Or also, I suppose the other issue is for some of the Chinese investors, it's getting more difficult to get money out of China. So all those things together with the reality of the excess supply developing in the market, we believe will lead to a significant reduction in demand from offshore investors. Gradually over maybe the next 3 to 6 months, in a year's time, we'll have seen, I think, a significant reduction of investors coming into this market.
Now, when we've discussed in the past, sort of hot property markets and Australia's sort of, property bubble potential, it's also broadly been discussed as this being sort of a Sydney and a Melbourne issue rather than being sort of across the board. However, your report does suggest that we are going to see that downward price action really across all of Australia's major capital cities. What's the common thread here?
Well, just a little bit of history on that. If you actually go from around 2001 through to 2008 or even 2010 in some markets, really there was a boom across all markets in Australia. Going back a little bit earlier, between 96 and 2000, leading up to the Olympics, it was very much a Sydney and a Melbourne-based boom at that point in time. But really between 01 and 08 and then even into 2010, the boom continued on and took hold in all markets. But really since 2010, it's been a Sydney and Melbourne focus, or I should say since 2012 when the market started to turn in Sydney. Remembering in the case of Sydney, the market had been pretty much depressed since the beginning of 2004. And so for over an eight and a half year period, there'd only really been one good year in that period of time when there was the first home buyer benefit that was assisting the market. So Sydney had been depressed for a long time really and was due for some price growth, but the price growth's been phenomenal. It's up about 55% in around a 4-year period. Melbourne's up probably more like about 35% in that same period of time. So really since 2012 it has been a Sydney and Melbourne story, and there's been little growth in the rest of the country. But in terms of where markets are headed now, obviously markets like Perth, driven heavily by the mining boom, are severely oversupplied, or will be. They're facing very low population growth. Population growth has come back from about a phenomenal 3.5% per annum back to about 1.2, 1.3. And really, even markets like Brisbane, where there hasn't been a strong price growth, there's a lot of construction of apartments going on in Brisbane, and that apartment construction is going to result in a significant oversupply given that population growth is not that strong. I suppose one of the other things to watch around the markets is that there'll be a big difference between what happens with apartments and what happens with detached housing. We think detached housing is probably only going to see very modest correction depending on the degree of oversupply in the particular capital cities, whereas apartments are probably going to see a more significant price correction, particularly in Brisbane and particularly in Melbourne. The Sydney market, on the other hand, we don't think is going to face significant oversupply, certainly not in the next 2 years. There's basically no risk of this market going into oversupply. 3 years down the track, 4 years, if they keep construction at too high a level, yes, there might be some oversupply and therefore a bigger correction.
And lastly, Robert, I wanted to ask, how does the interest rate scenario play out into all of this? We're currently at record low interest rates. There are expectations of possible further cuts. And what role does that end up playing within this pricing trend also?
Well, look, the outlook on interest rates is probably there's still a possibility rates might decline further in the short term before the end of the year. But certainly maybe in the latter part of 2017, if as housing construction comes off, and that's been a reasonable driver of economic activity, as that starts to weaken moving into the mid to second half of 2017, then the Reserve Bank might cut rates to stimulate the economy. In fact, our advice would be to the Reserve Bank is don't act early, keep your powder dry and take some action down the track when you maybe need to provide a more significant stimulus to the economy. So it's a pretty benign interest rate environment over the next 2 or 3 years. I mean, I've been watching the market for 30 years, and to get price corrections or even as the weakness that we're likely to see in the next 3 years only normally happens when we've got high interest rates. We don't have that scenario. So this is really a downturn driven by excess supply, driven by an excessive boom, and also now a slowing in the population growth, which is obviously a critical underlying driver of the demand for housing.
Dr. Mellor, thank you so much for the comments today. Much appreciated.
Thank you very much.
Our many thanks to Robert Mellor, Managing Director of BIS Shrapnel, for giving us his insights into Australia's property market. That's all we've got time for right now. I'm Natalie MacDonald. You've been watching Sydney Direct on Dukascopy TV. Until next time, it's goodbye.